Okay, hello everyone, I'm James Hart and welcome to this special Orbex market analysis session where we're going to be reviewing what we've seen from the major central banks in 2018, as well as giving an outlook for 2019. Now, it's been a very important year for FX markets, with many central banks moving away from the loose monetary policy which has been in place over the last decade since the financial crisis. However, this has come at a time of increased uncertainty around issues such as Brexit and the trade war between the US and China. And so this has created a lot of volatility and conflict in the market. So in this session, what we're going to do is recap what we've seen from the Fed, the ECB, the BOE, the BOJ, the BOC, the RBA, and finally the SNB, as well as consider what we can expect from them in the early part of next year and the implications that this will have for the currency market. So, as ever, if you have any questions during the session, please just write them in the chat function and I'll stop as we go along, and there'll also be some time at the end. Okay, so let's jump straight in then and kick off with the Federal Reserve, the US Federal Reserve. So 2018 has been a solid year for the US economy. We've seen output growing over the year. We've seen the continued tightening in the labor market. We got bumper second quarter and third quarter GDP prints highlighting strong growth. And growth over 2018 looks on course to grow at its fastest pace for 13 years. Now, alongside this, we've also seen the unemployment rate falling to its lowest level for 49 years. So these readings then highlighting the strength of the US economy over 2018. Now, one of the key events which has driven a surge in growth in the US has been the tax cuts that were announced earlier in the year by the Trump administration. And these have provided a strong fiscal boost for the economy. And over the course of the year, we've seen inflation remaining firmly above the Fed's 2% target. So we started the year in January at 2.1%. Inflation rose to highs of 2.9%. And we're currently sitting roughly in the middle of that range at around 2.5%. So we're still comfortably above the Fed's 2% target. Now, wage growth, importantly, also broke above 3% this year. And given the continued tightening in the labor market, it looks like there is scope for more upside in wage growth. We look at the latest NIB survey results, which shows that US companies are reporting difficulties with sourcing labor, which is forcing them to increase compensation levels. So in response to this broad-based momentum that we've seen in US economic performance over the year, the Fed has consistently raised interest rates. So we've seen 0.75% hikes over the year, which has taken the cash rate, the Fed future funds rate, to 2% to 2.25%. And in the latest meeting, the Fed made an important adjustment to its monetary policy statement as it removed the term accommodative when describing its monetary policy approach. So this is important because although it's simply one term, this has been in place since the financial crisis in terms of how the Fed has described its stance on monetary policy. So for the first time now in nearly a decade, it no longer describes its approach to monetary policy as accommodative. And this was taken as a very hawkish sign by the markets. So that's where we're up to so far in 2018, ahead of the final month of the year. So let's take a look now ahead then at what we can expect for 2019, sort of risks and opportunities. So looking ahead to the last month of 2018 then, just quickly, the market is currently pricing in one further rate hike in December, which would take the cash rate up to end the year at 2.25% to 2.5%. Now, the Fed is currently forecasting 3 further rate hikes over 2019. However, there are some dark clouds on the horizon which do need to be acknowledged. So the Fed has been very clear in its assessment of Donald Trump's trade war, noting the clear risks from a protracted trade conflict. Now, while so far the Fed has noted that it doesn't see any signs of negative impact from the US trade war with China, And until such signs start materializing, it won't have an impact on their policy decisions. It has continued to know the potential that this conflict has for negative repercussions on the US economy. Now, importantly, over the weekend then, we've seen a truce reached, or agreed rather, between the US and China during a meeting on the sidelines of the G20 summit. So the US has agreed to freeze tariffs at current rates of 10%. Over the next 3 months. So these tariffs were due to increase in January to 25%, but it's postponed these tariffs, with China reciprocating, saying that it will reduce tariffs on US automobiles entering the country. And during this 90-day period, the two countries are going to be engaged in talks aimed at delivering a proper trade deal. So obviously, if such a deal goes ahead, this will be a really positive input for the global economy next year and will be welcomed by central banks. However, it does also pose risks, because Trump has said if these talks fail to deliver a proper trade deal over the 90-day period, then Trump will press ahead with plans to increase tariffs on around $200 billion worth of goods to 25%, and has also threatened to tariff the remainder of Chinese goods entering the US. So this could be a very important event that happens in the first quarter of next year. Now, also clouding the horizon for the US are the delayed effects of higher interest rates over 2018, which will start to come into play heavily next year. And along with a stronger US dollar, this is likely to constrain activity. So just this week, we've seen that US construction spending has fallen for 3 consecutive months. And this is a trend which is likely to continue next year. Now, alongside this, we can also expect that the fiscal boost from the tax cuts announced earlier in the year will also start to fade. And given the outcome of the US federal elections this year, which resulted in a divided Congress, it seems highly unlikely at this stage that we're going to get any further tax cuts or even any spending increases next year. So this will essentially cut off any further fiscal stimulus to the economy. So as these combined factors start to come into play next year, the outlook for the US dollar actually starts to turn a bit lower. So for now, it seems that the 3 rate hikes that the Fed are projecting for next year are actually slightly in question. We heard Fed Chairman Powell this week addressing the New York Economic Club, and he was sounding decidedly more dovish, telling investors that he feels that the policy rate is now just below neutral. So this marks an important shift away from what Powell told reporters last month, where he was saying that the Fed's policy rate was still a long way off neutral. And these comments have raised concerns that the Fed is planning on slowing the pace of its rate hikes. So the December meeting is going to be particularly important then. It's likely that we'll still see one final rate hike for the year, but we might start to see a slightly more moderate tone creeping into the statement, giving the Fed some leeway for slowing down the pace of rate hikes next year. Okay, so that's the Fed then, and let's move on now to the ECB, the European Central Bank. So it's been a really important year for the ECB then. We've seen the bank reducing the size of its monthly asset purchase program, which was around 60 billion euros a month at the start of the year, to just 15 billion euros a month as of October, and it's currently forecasting that it will cease purchases altogether from the year end. Now, the first half of the year saw solid momentum for the Eurozone economic recovery. So we saw a broad range of indicators continuing to surprise to the upside, highlighting the strength in activity in the Eurozone. However, disappointingly for Euro bulls and for the ECB, over the summer we saw activity starting to turn lower once again, and since then many key indicators each month have been printing weakly. So the ECB has acknowledged this data weakness, and it continues to describe such data weakness as temporary, maintaining that the Eurozone economic recovery is still in good health. However, downward revisions to growth and inflation forecasts recently certainly don't encourage any optimism, and consequently we've seen the euro trading under quite a bit of pressure recently, as institutional investors have been scaling up their short exposure once again. So alongside the economic data weakness that we've seen in the Eurozone, we've also seen the Eurozone going through a bit of a rough patch in terms of political issues, which has created a lot of uncertainty among investors. So following the wave of elections that we had in the Eurozone earlier in the year, which highlighted the increase in populist support, more recently, the focus has turned to ongoing concerns such as Brexit negotiations, which are soon to come to a head, and also the Italian budget saga, which has been troubling the market recently. So it's been quite a tough year for the Eurozone. While things were looking up earlier in the year, recently the momentum has lost and it started to turn a bit lower. And so we've seen a very much more conservative and subdued tone from the ECB. Now, looking ahead to 2019 then, with the end of QE widely signalled, the market is mainly concerning itself with when the first rate hike is likely to come. Now, at each of its meetings over the last few months, the ECB has continued to reiterate its message that rates will stay at current levels until at least summer 2019. And for now, there's very little to suggest that this is likely to be brought forward. And as with the US dollar, as with the Fed rather, the risk is actually that we see an ECB rate hike postponed. Okay, so with global protectionism still weighing on the market next year, we've seen recently both the IMF and the OECD revising their growth forecast, their global growth forecasts lower in the wake of ongoing trade concerns and the outcome of Brexit, which is still as yet unknown. There's a chance that we'll see a further moderation and correction in the Eurozone economy, which could see an ECB rate hike pushed back until later next year. Now, alongside this, of course, the dramatic slump in oil prices is likely to start to feed into lower inflation over the coming months. And of course, there is still the potential that we see yet lower prices in oil, which would drag global inflation even lower. So it's important to consider, though, that this is, of course, Draghi's last term as ECB president next year, and it's likely that he's going to wish to bookend his time at the ECB with a rate hike, though such a move will, of course, be very dependent on how the economy performs over the first half of next year. And at its latest meeting, the ECB said that policy adjustments, future policy adjustments, will be contingent on data confirming the bank's medium-term inflation outlook. So if we do see a continued slide in oil prices and inflation starts to move lower from here, then this, of course, puts such a rate hike into jeopardy. So let's take a look at the euro-dollar chart then, the price chart, and consider the implications of this outlook on the technical picture. So if you look at the monthly chart then, let's get a bigger perspective on this. Looking at the monthly chart then, you can see that the moves in euro-dollar have been fairly ordinary. So after bottoming out over 2014 to 2016 with this triple bottom that we saw, we reversed higher, traded up, we broke out above the highs of that base, traded all the way back up to test this resistance zone here around these big previous swing lows. You can see we had these 4 big swing lows here. So we traded all the way back up to this point around the 125 mark, where you can see that we also have the 38.2% Fibonacci retracement from those 2008 highs. So a move back up into the 38.2% along with these prior swing lows was initially rebuffed, and we've seen price trade all the way back down. And what we're doing at the moment is essentially retesting the broken breakout base that we saw earlier in the year. So for now, while we hold here, there is still a likelihood that we get a renewed upside move. And in terms of projecting a likely path for the euro, we can see that if we map this initial rally off the lows, so we've got our initial impulse leg, a corrective leg, if we map this leg and then project it from the current point, that takes us all the way up into the 134, 136 region. And you can see just ahead of that, we've also got the 50% retracement from those big 2008 highs. So if price does start to turn higher from here, obviously the initial objective is a break of the 2018 highs around 125. And then beyond there, we'll be looking for the market to move up into the 134 region, which might prove to be longer term resistance for a renewed downturn in the euro. Now, alternatively, if we break lower from here, then the levels we're looking at to the downside are the 109.12 level, and then just below that, of course, we have the 2016 lows at around 103.35. So if we start to break lower, we've got very clear downside pivots marked out, and of course, if we break through the current 2016 low, then this will be a resumption of the longer term bearish trend in the euro and will spell big trouble for euro bulls indeed. Okay, so let's move on then and take a look at the Bank of England. So the main issue, of course, you must have been living on the moon if you haven't heard about this. The main issue for the landscape for the Bank of England this year has been Brexit and the sort of ongoing will they, won't they pantomime around whether or not the UK can secure a Brexit deal. Now, on the data front, key indicators were improving steadily over the first part of the year, and so this led the Bank of England to raise rates for just the second time in a decade since the global financial crisis, with rates having been increased from 0.5% to 0.75%, and now sitting at their highest levels since 2009. So the early part of the year was a bumper period for sterling and for the Bank of England. And although the Bank of England has continued to praise the economic recovery in the UK, which has been headlined by above target inflation, currently sitting at 2.4% as of last month, and record low unemployment of 4.1%, alongside rising wage growth at 3%, the BOE has been clear to highlight the risks around Brexit and the elevated levels of uncertainty which are clouding the outlook for the UK economy and for sterling. So looking ahead into next year then, again, the risks around Brexit continue to be the headline story for GBP, and specifically the BOE recently has been cautioning against the potential severe economic backlash which the country could experience if the UK government fails to secure a deal upon departing the EU in March next year. So we've heard Governor Carney saying that in his disaster scenario, house prices could crash by 30%, while inflation could spiral out of control as pound sterling plummets. Now, furthermore, the bank has been very clear that while the current economic momentum makes the necessity of further gradual rate hikes likely, there is also a chance that the bank could have to cut rates depending on how the Brexit situation eventually played out. So this is an important point to note then, because the bank is highlighting the two-way risk around Brexit. If the UK secures a deal and the economic recovery stays on course, then the bank is likely to press ahead with rate hikes. However, if the UK government fails to secure a deal and we see the UK crashing out of the EU without a deal, then the Bank of England could be forced to cut rates in a bid to buffer the economy. So for now, the base case scenario is that the UK will secure a Brexit deal and the Bank of England will press ahead with rate hikes in the early part of next year, most likely at the May meeting following the March Brexit date. So let's take a look at the technical picture in sterling again. And again, we'll be looking at the monthly charts because we're looking ahead into next year. So looking at the monthly charts then, you can see we're at an interesting juncture in sterling. So over the last few years, the trend has been clearly to the downside, and the chart currently looks like we're in the middle of a resumption of that bearish trend. So we've recently put in a lower high, and then we started to turn lower from this point. However, there is the potential that from where we are currently, sterling is actually setting up a higher low, which would position it for a rally into next year. So if price can stabilize around this current point and start to move higher, then what we'd be looking for, similar to the euro, is for an ABCD symmetry move. So if we map this initial leg, so if we map this first leg, correction, and then a second leg of equal proportion to that first one, that would take us up into roughly the 156 region. Now, the most important sort of milestones along the way to this target will be, one, a test of the current 2018 highs around the 143.68 level, and also a test of the longer term bearish trend line in cable running from 2008 highs. So if price can make it above there, then we'll start to gather some momentum and really push to the upside. Alternatively, if price remains below this point, then we're likely to see the range continue in sterling. And alternatively still, we could see price moving to the downside. If we break below the current lows of 126.93, then this opens up a test of the post-Brexit referendum 2016 lows of 114.28. And if we break down through those lows, then of course the longer term bearish trend is obviously in full swing again. Momentum will remain to the downside. So those are the key levels then to watch for cable. Let's move on then and look at the Bank of Japan. So again, another interesting year for the Bank of Japan. So the new yield curve control program that the bank introduced was particularly effective over the early part of the year in keeping yields down while global yields were remaining elevated. And this essentially helped the bank to keep the Japanese yen from any excessive strengthening. Now, in light of the general tide of hawkishness that we're seeing sweeping across central banks this year, the market soon began questioning whether the Bank of Japan would be the next bank to throw its hat into the ring and shift its policy away from accommodative monetary policy and start to normalize policy again, so start to move back towards raising rates. Now, with Japanese data improving over the first half of the year, speculation continued to build. And this was especially true as the Bank of Japan was seen reducing the amount of purchases that it was making at its bond auctions, at its monthly bond auctions. So the market deemed this as a sort of stealth tapering. This is what we were seeing in a lot of the headlines at the time, financial news headlines, describing it as stealth tapering by the BOJ. Expectations then grew further when the Bank of Japan announced that it was lifting the upper end of its range for its yield curve target from 0.1% to 0.2%. So this was seen by the market as a precursor to a more formal start of tightening. And the market was convinced that, again, the bank was laying the groundwork for a shift back to policy normalization, as we've been seeing elsewhere in the G10. However, Kuroda was keen to clarify at that meeting and also many times subsequently that these moves were not intended as any sort of tightening measure or as the precursor to any proper tightening measures, and were instead merely designed to inject volatility back into the Japanese government bond market. And indeed, Kuroda issued a rare piece of forward guidance at the meeting, saying that rates would stay at current levels for a very long period of time. I think the term he used was a very extended period of time. Now, importantly, it's also good to note that the bank's negative rates, which have been in place over the last decade, have been hotly debated this year. We saw the release of a study by a Japanese university professor highlighting the pitfalls and the dangers of negative interest rates and the need to remove them. Interestingly, Kuroda actually acknowledged this report and sort of the media attention around it in the BOJ's recent meeting, where he concluded that the bank feels that negative rates are still warranted at this point. Now, latest GDP data for the country showed disappointingly that growth shrank in the third quarter due to disruption from extreme weather, as well as a decline in exports amid fears over protectionism and weaker global demand. And the ongoing trade war between the US and China has been a particularly strong driver of price action in the Japanese yen, due not only to risk flows, with the Japanese yen tending to be bid due to its safe haven status in times of uncertainty, but also to the actual impact on Japanese trading. So news over the weekend of a truce between the US and China has been welcomed globally, and we've seen a strong improvement in risk sentiment. And indeed, if talks over the coming months lead to a proper trade deal, then this is likely to, if talks over the next few months actually result in a trade deal, so a proper trade deal, removing the tariffs which were in place, then this is likely to take a lot of pressure off the Bank of Japan. And in such circumstances, we could see the Bank of Japan starting to move towards tightening over 2019. So it's likely that the moves that we saw at the start of the year, regardless of the Bank of Japan trying to play them down, were in fact the bank laying the groundwork for some proper tightening and testing the water, so to speak. However, with the escalation in the trade war, which we saw over the summer, it's obviously messed with their plans and caused them to retreat somewhat. And of course, the Bank of Japan, Kuroda specifically, is very careful to protect against any excessive JPY strengthening. And so that's why we've seen such staunch defense of the bank's accommodative monetary policy and commitment to maintaining this policy going forward. However, if the trade war environment dissipates next year and we see a deal between the US and China, then we certainly could see the Bank of Japan start to move back towards tightening over 2019. So let's take a look at the technical picture then for the dollar yen. And you can see here, really, it's a picture of lost momentum and lost volatility over recent years. So after that strong rally up into the 2015 highs, we've got a strong correction lower down into 2016. And currently, over the last 3 years, it's the 2015 high and 2016 low, which have set the range in the dollar yen. And you can see from now that price action has continued to trade in a very sideways action, sort of in the middle of this range. Now, it's worth noting that we have recently broken out above the bearish trend line running from those 2015 highs, and we're also currently still supported by the bullish trend line from 2016 lows. So for now, the anticipation is of further upside in the dollar yen. So the main local resistance level that we need to see break in order to gain conviction with this view is the 114.58 level. So you can see this has been a really important resistance level for the market over the last few years. And on this monthly chart especially, you can see just how many times price tested the level but failed to close above it. And we're currently still sitting below there. So if we break above the 114.58 level, then this opens clear water up to the 118, mid 118 level, which was the 2016 high, so around 400 pips above there. And then above there, we have the 2015 high at 125.92. Now, alternatively, if we see a reversal lower from here, what we need to see is a break of the bullish rising trend line to get any sort of proper conviction of a shift towards the downside. And then what we'd like to see is the 2018 low around the mid 104 level taken out to open up a retest of the big 2016 low at around 98.91. So they're the levels I'm looking at then going into next year, the sort of higher term, longer term, higher time frame levels, just to be aware of as sort of broad market markers. Okay, let's move on then and take a look at the Bank of Canada. So, a really successful year for the Bank of Canada then in terms of continuing its path of tightening monetary policy. However, it hasn't been a smooth ride. So, we've seen stronger Canadian data over the first half of the year. And again, this is a theme which we've seen sort of globally, stronger data over the first half of the year, alongside rising oil prices. We had the Fed raising the rates steadily, which was paving the way for the Bank of Canada to increase rates. And indeed, the Bank of Canada has increased rates 3 times over the course of the year. However, it hasn't been a smooth ride, as I say, and the Bank of Canada has at times struggled with the presence of ongoing global trade wars and was weighed down, especially by uncertainty linked to the renegotiation of NAFTA earlier in the year. So the first half of the year then was marred, sort of the middle part of the year rather, was marred for the Bank of Canada by the conflict we were seeing in these NAFTA negotiations, which kept breaking down, kept passing deadlines, kept being postponed, and it looked at one stage like the US was going to scrap NAFTA, kick Canada out of a trade deal, and simply sign a bilateral trade deal with Mexico. So at the time, the Bank of Canada was highlighting this issue as the biggest risk to its outlook and to the Canadian economy. However, following continued talks and ongoing deliberation, Canada and the US were eventually able to come to a last-minute compromise and strike a deal on new terms for a trilateral trade deal between the US, Canada, and Mexico. So imagine the Bank of Canada's relief once this news kicked in. So with this uncertainty removed then, the Bank of Canada pressed ahead with its latest rate hike in October, and indeed the optimism was palpable in the bank's statement as it signalled that further rate hikes would likely be appropriate. And indeed, we even saw the Bank of Canada stepping away from saying that further rate hikes would be data dependent. So this marked a distinctly more hawkish tone from the bank, reflecting the sense of relief and optimism over these successful NAFTA negotiations. So what's in store for the Bank of Canada in 2019? Well, while the Bank of Canada sounded particularly enthusiastic and optimistic at its October meeting, since then there have been a few developments which the bank is likely to be less enthralled about. And of course, we're talking about the severe sell-off in oil, which is currently casting doubt on the prospect of a further rate hike in December. Now, although recent inflation data has continued to highlight resilient price pressures, it's likely that the sell-off in oil will start feeding into inflation readings from November onwards. And so we could see the Bank of Canada deciding to pause and take stock of the environment before raising rates again. And so with this in mind, it's more likely to expect the next rate hike to come in the first quarter of 2019. So with unemployment remaining low and inflation remaining above target, there's still plenty of scope for the Bank of Canada to continue its tightening program. And of course, with the global trade environment looking like we could potentially see some reprieve next year, the only issue for the Bank of Canada really is this sell-off in oil. OPEC are concerned that the market is swinging into acute oversupply, as we saw in 2014, which was essentially the cause of that huge collapse in oil prices. So if we do start to see a further sell-off in oil, then this is likely to see the Bank of Canada postponing tightening until we see a stabilization in oil prices. So let's take a look now at the technical picture for the loonie. So again, similar to the dollar yen really, the longer term picture is one of paused bullish momentum. So we had this really strong rally up into 2015 highs, sell-off down into 2017 lows, and again we've just been hemmed in this sort of sideways action, which for the moment looks like a bull flag in the loonie. And again, while we're still above this rising trend line, we've broken through one bearish trend line also. We're currently capped by another shorter term bearish trend line. While we're still in this situation, the anticipation is that we're going to eventually resolve to the upside. Okay, so we're currently hemmed in by the bearish trend line from 2017 highs, and we're also currently still sitting below the 2018 high of 133.77. So if we can break above this level, that will open up the way for a test of 2017 high at 137.86, and then above there, of course, it's clear water up to the 2015 high. So again, the current technical perspective indicates that we are likely to resolve to the upside. So if we look at this period of price action over the last 3 years as simply being a correction to the impulsive rally which we saw over the preceding years, then again, while we stay above this long-term bullish trend line, we are likely to see continued upside. Alternatively, if we break down through that rising trend line, then this opens the way for a test of 2017 lows around 120.67. And if we break below there, then of course this signals a proper shift in momentum and potentially the start of a bearish trend. So they're the levels that I'm looking at then for the dollar CAD going into next year. Okay, let's move on then and take a look at the Reserve Bank of Australia. Okay, so the RBA, 2018, in short, it's been a disappointing year for the RBA. It's been unable to get off the starting blocks in terms of rate hikes. We've seen rate rises across the board in other central banks, the Fed, the Bank of Canada, the Bank of England. However, for the RBA, rates still remain unchanged at current record lows of 1.5%, where they've sat unchanged for 27 consecutive months, which is also another record for the Reserve Bank of Australia. Now, one of the main issues over 2018 has, of course, been the ongoing trade war between the US and China, which is Australia's biggest trading partner. So this has taken a heavy toll on the Australian dollar. We've seen a lot of capital outflow over the year, and this, alongside with a stronger US dollar, still subdued domestic inflation, a weak domestic housing market, has offered very little opportunity for the Reserve Bank of Australia to tighten monetary policy. Now, while the RBA has maintained a consistently optimistic tone over the year, reaffirming its message that the next move in rates is expected to be up, okay, so we've seen all policy members now agreeing that the next move in rates is likely to be to the upside, with inflation expected to hit the bank's 2 to 3% target in the medium term. The bank has continued to acknowledge the weakness in the economy from issues such as high levels of household debt, weak household incomes, and falling house prices. And so we still have absolutely no clue as to when the RBA is expecting to raise rates. So although the bank has continued to say that it expects rates to move up in the next move, it hasn't said when. And again, the current rate of 1.5% has sat at these record lows unchanged for a record 27 consecutive months. So a very frustrating year for the RBA. So looking ahead into 2019 then, given the very stagnant momentum in the Australian economy, the RBA is not expected to raise rates until late 2019 at the earliest. However, given the negative skew, okay, so given the very negative expectations around the RBA and the Australian dollar next year, there is a lot of upside risk, okay, because expectations are very stretched. So everyone is thinking that the RBA is going to be sat on hold until the end of next year. And so obviously this presents a lot of opportunity, because if we start to see, for example, a pickup in inflation over the early part of next year, and this could come from a further decline in the labour market, which the bank currently expects, then this could cause the bank to move rates up sooner than currently expected. Furthermore, if we see a proper trade deal between the US and China, this too could be a huge boost for Aussie activity. So we've already seen the Aussie be the strongest beneficiary among the G10 currencies from the news of this truce between the US and China over the weekend. And if we actually get a proper deal in place over the next few months, then this could be a massive boost for Australia. So the Aussie is typically used as a proxy for trading China because of its strong trading links. And so such a trade deal between the US and China would put China back into first gear. So obviously there have been quite a few concerns about a slowdown in China linked to this trade war. So if we see a trade deal in place, this would create a lot of relief and optimism among Chinese investors. And this, of course, would translate into better activity for Australia. So again, if we see a trade deal, this could be another reason why we might see the bank actually move on rates quicker than expected. However, the key issues remain for now. We've got low wage growth, weak household incomes, sliding property prices, and until we see improvement in these key areas, the RBA is going to be remaining sidelined. So let's take a look at the technical picture then for the Aussie. Okay, and as you can see, the Aussie is currently sitting in the lower end of the sort of 70 to 81 price range that has framed price action over the last 3 years. So the last touch of this low then has actually seen price bouncing higher, opening up the possibility of a sort of double bottom in play here. Okay, so we could be seeing a double bottom in play. We've got a large bullish engulfing candle on that last monthly prim into these lows, and we've gapped higher. So this is a positive sign for the Aussie. If we start to move higher, however, what we're going to have to see to gather any proper conviction in this view is a break back above the broken bullish trend line from 2015 lows, and also a break above that 81 high, which has been the high of the range in the Aussie over the last 3 to 4 years. So if we can break back above that level, then this will confirm a shift in momentum for the Aussie and open up a test of higher prices, moving up first of all to this test this low here, so the sort of early 2014 price low around the 88 mark. So these are the levels then to watch in the Aussie. And of course, if we roll over from here and break the 70 level, and this of course opens up a test of the late 2008 lows around the 60 mark. So these are the levels that I'm watching in the Aussie. And finally, let's move on and take a look at the Swiss National Bank, the SNB. So in all, a fairly uneventful year then for the SNB, with monetary policy remaining unchanged. We've seen the target range for the bank's 3-month LIBOR rate remaining between minus 1.5% and 0.25% since Q1 2015, with rates on sight deposits stagnant at minus 0.75%. So there's been absolutely no movement on these then over the course of the year, and there's very little to suggest that the bank is likely to increase rates. So earlier in the year, we saw the market again beginning to entertain the prospect of an SNB policy shift. This was, similar to what we were seeing with the expectations around the BOJ. The market was looking around, seeing the general shift in central bank policy, with banks starting to tighten again and normalize policy. And so there were expectations that the SNB would be next to follow. And back in sort of the early summer, we saw the SNB revising higher its inflation forecast for the first time in the year, which again provoked expectations. However, the SNB has been very clear to reaffirm its status in the market, which is to maintain an easing bias and to prevent against any excessive CHF, Swiss franc, strengthening. So the issue then isn't related to the Swiss economy. So GDP is expected to come in at around 3% for 2018, and inflation has recently started to rise again. So the economy looks stable. The problem is the SNB is very careful about protecting against any excessive Swiss franc strengthening. So the SNB warned earlier in the year that it would maintain a presence in the market due to the risks posed to the Swiss franc as a safe haven currency from issues such as the trade war between the US and China, and indeed tensions and uncertainty around Brexit and Eurozone political issues. And so while we see these risks remain in place, the SNB is likely to maintain its easing presence in a bid to prevent the Swiss franc from strengthening due to safe haven inflow. Now, looking ahead to 2019 then, given the risks that are remaining over the next year stemming from ongoing European political dramas and the global trade war conflict, and also a potential further collapse in oil markets, the Swiss franc is likely to remain supported, at least sporadically reported, by safe haven inflows, meaning that the Swiss National Bank is going to have to maintain its current easing bias, remaining active in the market as necessary to keep the Swiss franc from excessive strengthening. However, if we see Brexit pass successfully with a deal agreed between the UK and the EU, and especially so if we see a trade deal done between the US and China in the first quarter of next year, this could cause a huge rally in risk sentiment, which could pave the way for SNB policy normalization through next year, though most likely this would come after an ECB rate hike, which the SNB would like to see in order to make sure that there isn't any strong or excessive inflow into the Swiss franc. Okay, so let's finish off then by taking a look at the technical picture in the Swissy. So looking at the Swissy then, over the last 20 years, you can see it's been a story of Swiss franc appreciation against the dollar. So you can see the dollar Swiss has moved consistently lower from 2000 down to 2010. However, from 2010, we started to correct higher. But recently, over the last 3 to 4 years, we've been caught in this heavy sideways action between lows of around 91.75 and highs at around 103.40. So this has highlighted the lack of momentum and the contraction in volatility. We've seen price breaking above the bearish trend line from 2005 highs. So this was a strong positive start. However, we didn't make it above the structural high, which we saw on that 2014 move. And this is where price has been hemmed in. Now to the downside, we retested the broken bearish trend line and we held and we traded higher. And indeed, we're currently supported by this rising bullish trend line off the 2010 lows. So for now, the expectation is that we could actually see a break to the top side here. If this bullish trend line remains intact, then we're likely to see a break of this 103.40s level in the coming months, which would open up a way open up the way for a test of further resistance up at the 117.70s level. So if we do start to see some improvement in the trade environment next year, and we start to see the Swiss franc moving lower, then this would open up the way for the dollar Swiss to break out here and start to trade to the top side. Alternatively, if we get a break of the rising trend line from 2010 lows, then what we're going to be watching is a retest of that 91.75 level, because if we get a break here, then this signals that the longer term bearish trend is likely in resumption, and we're going to be watching, of course, for a move back down to those 2010 lows. Okay, so that's what I'm looking for then in the major central banks going into next year. As I say, it's been an incredibly interesting year for the FX markets. We've seen a dramatic shift in tone and policy approach by many of the central banks, and other central banks are clearly poised on the verge of changing their policy. However, there are still some key issues remaining: Brexit and the trade war. So over the first quarter of next year, these are going to be the two massive themes which we're going to be focusing on, and of course, the direction of oil markets. So there's obviously two-way risk here. If we see a Brexit deal go through and the UK leaves the EU with a favourable deal and a long and smooth transition period, this is going to be a major boost for risk sentiment. Alongside this, if we see negotiations between China and the US end successfully and a proper trade deal put in place, then again, this is going to be a big boost for risk sentiment. And if OPEC and other global oil producers are able to reduce their supply enough in order to push oil prices back up, then again, this is going to boost risk sentiment. Alternatively, if we see Brexit go through without a deal, the UK leaves the EU without a deal, if the US and China fail to agree a trade deal and Trump raises tariffs on Chinese goods, and if OPEC and other oil producers fail to address the oversupply in the market and oil prices collapse further, then of course this is going to weigh massively on risk sentiment, and of course it's going to postpone a lot of the tightening programs that we're seeing across some of these G10 central banks, and perhaps even lead to some rate reductions. So some very interesting themes to look at then in the first part of next year, and look forward to catching up with you all in the new year to see where we get to with these perspectives, and see where the market moves, and if we get any major breaks in terms of the levels that we've been looking at. So just before I wrap it up then, are there any questions I can answer for anyone? Great. Okay. Well, look, I'm pleased that you've all enjoyed today's session then, and thank you for your company, your contributions, and best of luck with your trading, and I'll catch you all next time. Take care now. Thank you.